We might start off now and go through a couple of topics tonight. One is on the bond market, which is more about the bond market is all about the government bonds in both Australia and overseas, and how we value them, and how they can have either a capital gain or a capital loss. And the second issue will be looking at autonomous cars and how potentially that's going to change the world in the next 20, 30 years. So some major changes there in the way we potentially travel around to work and pleasure and normal daily lives. So the first one is going to be looking at the bond market. And the key thing there is that a lot of your portfolios have bonds in it. So we're obviously pretty keen to understand how that's work and make sure we get the right story there. So the bond market is, just going to get this working. So the bond market, there you go. So bond market is part of your fixed interest portfolio. And so for a lot of people, actually I'm just pushing the wrong way, I think, yeah, that's it. So the bond market is part of what we call fixed interest. So we know about, so we know about property, we know about shares, but fixed interest is things like your term deposits, as most people understand that. But government bonds is part of that portfolio. So we'll talk about how much is in there in a minute, but we'll talk about how they work first, and then we'll come back and talk about why is it important for you. So the main thing about government bonds, it's a way of governments getting money from the public, whether it's big institutions like super funds buy government bonds, you've got government bonds in your portfolio, and that's the way government finances its whole investment theme. Government bonds have been going around for about 500 years. They were actually initially started in Florence, and when there was a war between Florence and Venice, and the state of Florence, which was an independent state in Italy, ran out of money, and they started a war to fight. So they said, well, how can we get some money to keep fighting on? So they said, we'll promise to pay you, but we can't just pay you just yet. We'll wait till we win the war, and then we'll pay you back. And that's how the concept of government bonds came about. So they're the safest asset class, but you get relatively low returns. Oh, go back here. And the other thing is that they can be bought and sold. So when you take a term deposit out, you can't go and sell out on the open market from a bank, but you can sell a bond. You can sell it to someone else who might want to buy that bond, because you'll still get your money back at the end of a period. So if you had a 10-year bond here, you'll get all your money back plus we call coupons or interest along the way. So instead of calling them interest, they call coupons, because they used to have a little tear out at the bottom of your certificate. You had little tickets at the bottom, and you used to tear them off, and that was called a coupon. And they still use that word today, and that's effectively you go back to the government and say, here's my coupon, give me my interest for the 6 months or 12 months. So we call them coupons instead of interest. And they can go up to 10 years in Australia. In America, they can go up for 30 years. So the government in America can promise to give you your coupons every year until 30-year bonds mature, and then you get all your capital back, what you put in. But along the way, you can sell them to someone else, and that's the key thing we're going to talk about today, is that the price you sell them at, or value that they're valued at, can either make a capital gain or a capital loss. So when we think about term deposits, we don't think about capital gains or losses. We just think about the fact that you put your money in for 6 months, you put 100,000 in, you get your 100,000 back plus interest. But here we can actually play a game along the 6-month period of selling them if interest rates go down and make a profit. But if the interest rates go up, if we sell them, you'd make a loss. There's also corporate bonds, which are really where corporations like BHP or Rio Tinto would sell a bond as well, but we won't talk about that today. We'll just talk about the government bonds, because that's the most commonly understood. So the next thing is, so that's how governments get money from the public, through bonds mainly, and since 1990 they've been giving you very good returns. Now, how can they give you good returns? Because we know interest rates are very low now. We're down to 2%, 2 to 3% in bank deposits. Government bonds are around about 2.3%, I think something for that, around about that number for 10-year government bonds in Australia. But the key thing is this drop here. So if we go back to 1989, if you remember that far back, we had very high interest rates in Australia, and people paying off their loans were paying up to 17% on the home loan. But since then, interest rates in bank interest rates and bond rates have all dropped and dropped. So now where they're pretty low. This is a bit old, but there was about 2.3% interest rates on a government bond in Australia, and in US the same things happen. So all around the world, you can actually look at other graphs, but you can see this gradual decline. And that's because we came off fairly high inflation during those periods, and now we've got low inflation. That's one that determines what these bonds will sell at. So along the way, anyone who had a bond portfolio has been making capital gain, because as interest rates fell, the price of the bond went up, and therefore you made a capital gain. Now that would show up in your portfolios either as a realised capital gain or an unrealised capital gain, but it shows up in a capital gain in the value of your investments. So it's just like if BHP went up in price as a capital gain, you can either sell BHP at a higher price and make it a realised gain, or you just can keep BHP and just have it valued at a higher price. So interest rates have been declining for a long time, and the concern though is if interest rates go up, you can lose money on bonds, because you have to think that if someone wants to buy your bond and interest rates were low, they won't buy your bond with a low interest rate. So, quick example, if interest rates are 5% and the interest rates went to 10, obviously, and you've got a coupon coming out at 5%, people don't want to buy a 5% interest rate, they want 10, and you have to discount the value of the bond to get it sold if you want to sell it. But the key thing here is the important part now is that interest rates are starting to pick up. So in the US, interest rates are starting to pick up, same in China. So there's going to be some losses in the bond market, potentially as we go through an interest rate up cycle. So bond rates have fallen around the world, we know that. Inflation rates have also fallen, that's really why they've gone down. And we'll now look at bonds now compared to other investments. So we know that bonds are very safe, but that also means there's a capital, they've got a capital guarantee on them from the governments, but that also implies that you get a lower return because you're getting a guarantee from the government. And that's why bonds are always the foundation of every other return. So term deposits are a little bit higher return, then you go property, and then you go shares, because you get less return for more guarantee. So going back to the 10-year bond, so we know that since about 80, well, even going back to the 80s, the interest rates, the bond market's been falling. But if you bought commercial property, you're roughly getting around 8, currently about 6%, but 6 to 8% is what you would buy a commercial property at. And these are things like Westfields or your big CBD properties, they'll be giving 6 to 8% interest, or rent, as you know, of properties. Whereas today, your bond's only getting less than half that. So if you look at it as an investment, you'd say, well, I'd rather buy some commercial property than some bonds. And that's going to be the problem for the future, is that if interest rates are low and then also you make losses, why do people want to buy bonds? This is a bit more busy graph, but you can see residential property generally gets about 3% after costs. So buying residential property doesn't really do much for you. And you can see the bond rate, the red line over here, it's below the residential rate, so it's the lowest rate. Then you've got residential property, then you've got commercial property in the gold, and then you've got shares in the black. So you can see here there's a whole range of returns or income coming in. The property's best, second best is shares, third best is your residential property, and worst is your bonds. And that's generally what happens over time. Your bond's always going to give you the lowest interest rate. So let's look at the bond rates the last few years. So let's look at the last 12 months. You can see here we've got a loss showing up on the bond portfolio. So we know we're still getting our coupons, we're still getting interest off a bond about 2.5% on this is a bond portfolio from everything to 1 to 10 years. And the average coupon's about 2.5%, but the loss is 4%. So the net loss for that portfolio for 12 months is down 1.7%. And you've got some bonds in there, but we'll go and show you how much in a minute, but there's not a lot there. Go back 3 years, you've been making capital gains. So you made a 1% capital gain over 3 years, coupons 2.4, and your total return's 3.6. Go back 5 years, there's a little bit of a loss coming in there, but overall your returns have been around 3 to 4%, 3 to 5 years, but now we're starting to see negative returns. Overseas, in Australian shares, if you compare it to Australian shares, last year up to 30 June you did about 9%, you got your dividend plus your capital gain. 3 years, you got your dividend plus a capital gain, and over 5 years you got dividend plus a capital gain, so all positive there. But going back to 2007, when obviously go back 10 years, you're hitting the GFC, you can see there's a negative in there, and that's because if we look back to the GFC, we haven't got back to where we were 10 years ago. So there's a negative there on the value, but the income's been coming in every year for the last 10 years, 4.6%. So if you just look at the income, you've got 46% income over the last 10 years on the share market, but you've lost 18% on the value. So the share market's still down about 18% to where it was. So overall, you'd still say that in most cases your shares are doing better than bonds, but except for the, so for every year in that period, shares have done better than bonds, but they're more up and down as we know. So just to show you the term deposit rates over the same sort of period, if you go back to 2007-8, we had very good interest rates around the time of the resource boom, around 7-8% interest rates, and then the share market fell and that pushed up the dividends on shares. So people were saying, oh, if the share market's down, we'll sell our shares and buy term deposits. But of course then they fell in 2008 and 9, came back up again, and now we're down to 2 to 3% again. So whereas the share market income's been going up along the way. So the story there is don't sell your shares when they're cheap, because you're selling off a high income to someone else. So comparing the different returns, we know that over, say, 10 years that bonds will be roughly the worst, then you get housing, and then you go to term deposits, property and shares. So bonds are a safe investment. As long as you hold them to maturity, you'll get your money back plus your coupon, but you may miss out on a higher interest rate if interest rates go up. That's the problem. You're saying, well, if I have to sell that bond along the way, I'm going to have to discount it to sell it to someone else. But the bonds are always going to be the safest investment, and so every other investment return is going to be higher, relatively higher, but they're always going to be the foundation of all investment returns. So, as I said, when interest rates go down, you make a profit on bonds. If they go up, you make a loss. Now, currently, if you looked at if you bought a 10-year bond and interest rates doubled, they must drop in value. And currently, if interest rates doubled on a 10-year bond, you'd have to drop the value by 22% to sell it to someone else, because they've got to buy it at such a price that they get that high interest rate on what they buy. So 22% on a bond is a discount to what you'd have to sell it at if interest rates doubled. And if interest rates went up 1%, you'd have to drop about 8% in value to sell a 10-year bond. Now, if you sold a 1-year bond, you don't get as much losses. I won't go into reason. Basically, the reason why is because you get your money quicker and then you can reinvest it. So anyway, we know about bonds. They provide a coupon, and that you can have a negative return if you get capital losses on it. But most people are in a diversified fund, so you're not just in bonds, you're in overseas shares, Australian shares, property, government bonds in Australia and overseas. So the key thing is you're not going to see a great deal of loss, because a very small proportion of the portfolio is in bonds. As I said, if a 10-year bond, if interest rates went up 1%, you'd lose about 8.6. Now, we haven't started raising interest rates in Australia, but they have overseas in America. They've actually raised their interest rates 3 times at 0.25% per time. So they've gone up 0.75% in America, and they're losing money on their government bonds in America. They haven't risen rates in Europe, and they haven't risen their rates in Japan. So you've got money in all those different countries and regions. But the key thing in Australia is we don't see interest rates rising. Maybe they might rise next year. We don't know. Don't know what's going to happen. But if they went up 1%, you'd actually have to have 4 interest rate rises, because they're normally only raising interest rates 0.25% per time. So 4 interest rate rises might take you 2 years before it fully came through to get a loss of 8.6% on your bond. In which time some of these bonds might have matured and you might not have lost that much money as well. So that's sort of worst case scenario. Because the longer the bond, the longer the bond, the more you lose if interest rates go up. And you can only have 10-year bonds based on Australia. So in the US, they've already gone up 3/4% rises, and the US is in a full recovery mode. Their economy is doing very well, so they probably might have more interest rate rises next year, which will mean their bond portfolios will drop in value. And you've got some US bonds in your portfolio. The reason why interest rates have been so low is because around the world we've had low inflation. So if you look at the orange dots there, you can see around the world very low inflation. But if you look at the US, their inflation's about a little bit below 2%. Australia's around 2%. But you'll always get a bit better rate on your bond than inflation. Now the reason for that is if you buy a bond at 3% interest rate or coupon, you're getting 1% above inflation, because inflation's 2%. If you're going to lose 2% of your money because you can't buy something in the next 12 months, it's 2% more costly. You need at least 2% to compensate you for putting your money away and not spending it today. So at this stage, most rates inflation rates around 2%, and that's why you're getting a bit more than 2% in your bond portfolios. But if inflation rises, then you have to raise your bond rate, because otherwise people wouldn't invest them. Because they're saying if inflation rates go to 3%, you need at least 3% in your bond portfolio to be wanting you to invest. Otherwise you're losing money. So we've seen in the last 10 years, since 2007 and 8, huge drops in interest rates, because we had the GFC and around the world, people didn't want money because they weren't investing in new cars and new houses and buying things. So you had to really discount the price of money to get people to buy it. And that's why you can see in the US, rates went from 5% nearly down to I think about 0.25% or something like that. They're just starting to rise now. Australia's went down. We were up to 7 or 8%. We were down about 2 to 3. China's gone down. Europe's gone down. All these were responses to the global financial crisis to get people to start spending their money again. Because if people had money in the bank and in bonds getting a low return, they say, well, I'm going to go and buy a new car, I'm going to do something. That stimulates people to buy things. Because if you're not getting a decent return, you're going to go out and spend your money because you're not getting rewarded for your investment. The other side of the coin is it makes it cheaper to borrow. If you want to buy and build a new factory and your interest rates are very low, you don't have to pay so much back. And so that makes your new business much more profitable than it would be normally. And so that gives an incentive, one, for people to spend their money, and two, to invest it to get the economy going again. So the Reserve Bank hasn't increased rates for a long time. But they could start next year or the year after, so that could reduce your value of the bonds. Also means the economy is, if interest rates do go up, it means the economy is doing well. The Reserve Banks raise interest rates, one, to reward investors, but also to stop overconfidence in an economy. If you raise interest rates, people can't afford some of that, so some people drop off in buying a new car or buying a new factory, and therefore you control the economy that way. It's like putting the brake on the economy. That can be used as a brake to pull the economy back. So if interest rates are low, then you go and put money back into growth investments because you can get a better return. But secondly, if bonds are actually losing money, that gives you an incentive to pull out and go back into growth investments. Now in America it's a very clear correlation. Generally if interest rates go down, the share market goes up. If the share market falls, people go back into bonds. So we don't have as much correlation here in Australia because we actually have, a lot of investors go into the housing market, whereas they don't in the US. People invest in bigger houses for themselves because they get a tax deduction for the house that they live in. So when they pay down their own home, they then go and buy a bigger home rather than going and buy rental properties. So there's a big difference in the way to do it. But anyway, in the US, if the bond market's going down, people will take their money out of bonds and go and buy it in the share market. You've probably heard the US share market's on an all-time high, and this is one of the arguments to say that the US share market should be fairly positive for the next few years because people will be taking their money out of the bond market because they're losing money. So how do we reduce the losses? Because you know, if we're saying we've got money in bonds, what do we do? What should we do? Should we sell all our bonds? Or should we do something else? In the portfolios you've got, what we've been doing is been selling out of bonds all the way since 1990. Because as we made a capital gain, the value of the bonds went up and we had to bring it back to what we call our benchmark. So if bond values went up 5%, we had to sell 5% down. So we've actually been reducing our bond portfolios for roughly 27 years. So you're not overweighting bonds relative to what other people could be doing. The other thing to remember is that we don't have, a lot of your portfolios are around 70 to 85% in what we call growth investments. They're property and shares, so the actual bond portfolio is quite small. Because we know that the bonds won't do well over 5 or 10 years. And we don't put a lot in there, but we've got to use some as a stabiliser. So we've got your diversification. The old rule of diversification is that you don't put all eggs in a basket, you know all that. But the key thing that we've got to worry about is if inflation goes up very quickly, or we have what we call a change in the consumer in China in the way they spend money. Now, in China and a lot of parts of Asia, they save like crazy. Some in China, they save about a quarter of their income every year. We save about 5%, up to 10% of our income each year. They're very big savers in China. And the key thing for them is they've been trying to find a home. They didn't use the Chinese banking sector. They went to America primarily and Europe and bought government bonds. So they've been supplying the Western world with a lot of this money that we've been using to spend our way out of recession. And the national debt, you probably hear about this in the US, they had a clock which was showing how much debt was running up every second of the day in the US. It was 14.2 trillion at that time, and how much each house in America was owing just on their government debt. But a lot of first world countries have been running up debts like crazy, and it's in government debt. Australia's not too bad. We're at the bottom of this table here, but you can see in the US from 2006 to 2012, they've taken their debt from around 70% of their gross national product, which is just a measure, to about over 100%. Now, you can't keep doing that. It's like, you can't keep borrowing more and more money because eventually you've got to pay it back. A lot of other countries have actually reduced their debt. Some, like Luxembourg, are still going up, but primarily most of the other countries in the world are keeping their debt down, except there's a few like Italy and Greece, which got into problems during the GFC. They've done a bit, but they haven't got a longer-term graph on them. But you can see a lot of countries here have got over 100% in GDP debt, just on government debt alone, not housing debt and not corporate debt. So these countries are extraordinarily highly in debt, and it's primarily to the Chinese savings. They're coming out of China. Yes, Alan?
Does that mean that, for example, like Japan has exposed itself to a major crash or something?
Japan's a little bit unusual because they've sourced it from their own population. So they haven't had to borrow it from China or anyone else. They're actually one of the few countries that rely internally on their own servicing of the government debt. Doesn't mean that, and they've also artificially kept interest rates lower. They're actually, I think it's negative 0.25 interest rates now. You actually get, if you buy a government bond in Japan, you get less money than you started with, which is an odd concept. Anyway, Japan's a bit an odd one, but the rest of the world, like Greece and Italy, they're sourcing a lot of their debt from overseas, and a lot of that's coming from China.
So if they default, then they'll collapse.
Well, default, yes. There's a lot of things that happen when you default as a government. Yes, you can't borrow any more money for a start, and two, you then have to usually go to the IMF and they say you've got to cut spending, you've got to do lots of things to remedy the problems, because the problems usually come about by obviously first too much government spending, but secondly that usually their economy isn't being run properly. That is, they probably have too many subsidies to their corporate sector. They might not have the right exchange rate, or a whole range of things. But that's when the IMF steps in and says, if you're going to get money, the IMF is a lender of last resort. They'll lend the money to get through, but they then put all these conditions on them, and the World Bank as well. But yes, you're right. Countries do go broke. Last time, the most recent, Greece technically didn't go broke. They just Greece in recent times they actually just reshuffled their debt to make it long-term debt rather than short-term debt. But there's a lot of countries that have been broke. Last time England went broke was 1596, so it's a long time ago. But China's been in default with their government bonds 3 times, Brazil 10. So there's a whole litany of countries that do default on their debt. There was a time when we nearly defaulted on New South Wales government debt when a guy called Jack Lang decided that he couldn't pay back the government debt in the Great Depression, but he got thrown out of Parliament and they decided to continue paying debt, so we never went into default. But we nearly went into default once, but there's a whole story about that that time. But we're going back to China now. If China stops giving the world money to spend, what would happen? What happens is you've got less money for these governments to borrow, and therefore the price of money must go up because there's less of it. Because if you're going to attract money into savings, you've got to give them a good price, right? And the price is called interest or coupons. And the key thing here is showing you where we've seen this massive, you can't see it, but from year 2000 there's been this massive build-up of savings coming into the world. And this story is that you've got South Korea and China and Japan providing the world with lots and lots of money. And that money has been then borrowed by countries like Australia, New Zealand, UK, and we've spent it. Now, we might have spent on roads or railways, we might have spent on social welfare, but the key thing, we've spent that money and we still owe it back to basically the Asian region and the Middle East. Now, what would happen, now, to get you an idea, China's that bit there, so that dark bit is where China's supplying all this money. The key argument is that in the next 10 or 15 years, China will stop saving so much money, they'll start to spend it. And that would mean that supply of money is going to contract, and that would then change the whole equation of this savings. But the other issue too, of course, is the major oil exporting countries have run into problems because they used to have oil at around $100 US a barrel, and now it's down to $50 to $60 a barrel. Now they've effectively halved their incomes, but they've built up a lot of social welfare systems in places like Saudi Arabia and the Emirates. A lot of countries like Nigeria and Venezuela rely on that oil export to keep their country going. But along the way, they're not saving now. So the drop price in oil means these countries can't save. In fact, they're now coming to borrow money from the world. So they're going from net savers to net borrowers. And that changes the whole equation, this savings glut. And that's what we're sort of seeing, is that potentially we may see interest rates go up very quickly because there's a shortage of money. Might not be because of inflation, because inflation's low, but it's because we've got less money coming in to actually use for governments to use. So this is just a few extrapolations of what might happen. The deficit spending around the world has been chronic for the last 20, 30 years. France has run 26 deficits for 26 years. And they've never really approached making a surplus. Australia's gone through periods of making surpluses during the Howard years. under the governments, and ever since then have been running deficits. And the consequence is we're running up to about $300 to $400 billion of debt, whereas we had no debt 10 years ago. So we've run up our debt, but we're not in bad territory, but we're not too much in debt, but we have run up a lot of debt very quickly. But the key thing is it's going to have an impact if this money is not available, and that's where potentially interest rates could go up from the shortage of money. Now it might take you 3 years, 5 years or 10 years for this to all impact, but it's a longer term impact on what we call the bond market. So instead of having 27 years of capital gains, we might go through 27 years of capital losses. I'm not sure. But it won't be significant because interest rates, won't be going back to 17% interest rates. We'll probably go up to 3 to 5%, which is the normal rate we've been getting used to. So you've got most of your money in growth funds, not in bonds. And if interest rates do rise, you're going to be very small losses in your portfolio because you've got very small amounts. To show you how much you've got, for most people they're in the balance fund, which is the standard fund most people use. You've got about 13% of your funds in bonds. And you might lose, let's say you lose 10% on that, that's 1.3% of your portfolio. You've got about, in the growth portfolios, because you've got more shares, you've probably got even less. So if you've got a 10% drop in your bond portfolio, it'll be 0.69. Now, most people, our portfolios have been getting about 5 to 6% income each year. So that would detract a little bit, but it wouldn't wipe you out, wouldn't give you negative returns. So what we're saying is, your portfolios have been quarantined in a couple of ways. One, we've been selling the bond portfolio when the capital gains got up. Two, we've got a small amount in bonds in your portfolio. So if you do hear that the bond market's going through a bit of we call it a crash, but all they're saying is the value's dropping, you're really not going to impact you in a major way in your portfolio, because what will happen is if the people are selling bonds, they're going to buy your shares and property, and you've got most of your money in shares and property. And that's where you'll get a gain to offset any losses here. And because you've got more in the shares and property, any gain will be much bigger out of the shares and property as a consequence. So basically, this whole concept is to say that you're not going to be badly off in this sort of scenario. So coming on to something that's a bit more interesting, autonomous cars. Have you, pretty much everyone's heard about how that's going to change the world, or make you have your car pick you up every morning and take you to work? Interesting concept. So I mean, the concept has been sort of thought about for many years, and there's the Jetson there going off to work in a hovercraft or something. But it's quite obviously complex, to get a car to go into traffic, know when to stop, when to start. But really, when you think about it, a lot of cars already have a lot of these autonomous features already. You've got power steering for a start. All you need is electronics to steer it. You've got automatic gearboxes. You've got, you probably don't realise this, but most people don't have an accelerator cable on your car anymore. You've actually got the same thing as the remote control cars have. They've got a little indicator on the bottom of your accelerator pedal that goes and transmits to the actual accelerator carburetor. There's no cable in between. And therefore, you don't even need an accelerator really, you just need electronics to tell how fast the car can go. For indicators, you can do that electronically if you need to. So a lot of things are already in your car that are actually, even cruise control, I haven't put that in, which does control your car to a certain degree. So the next thing is, how do you move that forward and get to a car where it takes you to where you want to go? And the big issue is the GPS system, is being able to know where you're going and to track a route. That's really until we got that, we never really were able to go to have autonomous cars. And the other thing that is that you want a fairly accurate description of where you are, because if you're 2 metres if your GPS system doesn't actually tell you where you physically are, you might be 2 metres or 1 metre too far or too close to somebody else, a curb, another car, and whatever it may be. So you've actually got to get very accurate GPS systems as well. That's a bit of an example of a GPS, the Google car, which one of the things you notice here is how small it is, because most people actually only do one person travel. You know, you're not taking 3 or 4 people in your car. You don't really need a big car for most people, because you're only doing one person passenger travel. And if you're going to be in a autonomous car and you're going someplace and another person wants to go to another place, well, you don't need 2 people in there anyway. So no, this one has no steering wheel or pedals, so it's all autonomous and going to take you to where you want to go. But the hard part in this whole process is to actually get the sensors to know what's in front of you or behind you. And that's still work. The technology of that is still getting developed, because the problem we've got so far is a computer can't tell whether that's a bagel or a dog. And another thing that Volvo found was that they could recognise deaf animals, but they couldn't recognise a kangaroo, so which is pretty important where we live. So there's a few issues there, but and there's a legal issue about if you ever have an accident. One person's not driving, the other person's driving, who's at fault? Well, everyone's going to say, well, the person who wasn't driving is at fault because they ran into you. But there's got to be some issues around responsibility. Is it responsibility? Is it the insurance company going to pay up, or is it the manufacturer because they may have had a fault in their sensors, and maybe that's the manufacturer wasn't provide you with a good sensor system. So there's a few issues there, and obviously government's got to regulate this and put in legislation to allow them to actually be on the road before they can get registration. And the main issue though is going to be cost, I think. This is the thing that, as I said, most people don't have more than one person when you're driving around, and there's a big efficiency argument in this, because if you can get to work much cheaper, then you would start to adopt this technology, assuming it's going to be safe and assuming it does all the things you want it to do. But you can see here some really big cost savings per car that you can factor into your family budget. And you know, people driving around large cars, they're costing a lot of money. Now a lot of people say, oh, it doesn't cost me $13,000 for a large car. But what most of this, or half this cost, is your depreciation. Because you're buying the car and it depreciates and then you sell it for nothing 10 years later or whatever. So a lot of that is not your running cost, it's a depreciation cost. So if you didn't have to buy the car in the first place, you've got a big saving. The second saving is you're not paying for fuel and maintenance and all those other things, rego, because that can be then shared with other people. Because if you've got a car that you're only using for an hour a day, there's other 24 hours somebody else can be using it. So you're going to be sharing that cost around a whole range of other people, effectively like a taxi. And the other issue is a lot of these very crowded cities like Sydney and Melbourne, people in the inner areas don't really often have cars now. They just go by public transport or taxi. So they're used to getting not relying on cars, because cars have to have car spaces. A car space in Sydney probably costs you $1,000 or $2,000 if you're in the inner areas of Sydney, just to rent or have to buy one. So a lot of people are actually not using cars. Well, not a lot of people, but there's a percentage of people who don't use cars, especially in New York and London, where congestion is just so huge. And the big issue is that you don't use your car for most of the time. 95% of the time you're not using a car. So as I said, if you can get someone else to use it for 95% of the other time, you're sharing it with a lot of other people in that resource. And it's the same as, it's the same concept as the Airbnb. You know, lots of people have got spare bedrooms, and all they're doing is saying, well, you can use that resource to rent it out. And Uber, the other one is Uber, which is obviously using people's personal cars to do taxi fares, because most people don't use their cars for a lot of the day. So the big thing is this sharing is that we're going to get the cost down. So if you can save $10,000 to $15,000 or whatever it is on your cars, there's going to be a big incentive for people. Probably in the second car market, because a lot of people have two cars. One, the husband goes to work, parks his car, the wife's still got to pick up the kids, take them to sport. So you've got a lot of two-car families in Australia, particularly Canberra, because our whole city's based around cars. So if you might still have the family car, but then you have the second car becomes the autonomous car, where you may own it, or you may just have it on a hire system through Uber or one of the hire cars. But the first thing is that most of these cars are going to probably be electric, because they can then be fairly cheap, and you don't need the complexity of a hybrid car for a start. And they can be refueled when they're not being used. So the peak demand is always going to be between 7:30 and 9:30 in the morning, and then from 3:30 to 5:30 in the afternoon. There's a lot of time when even these shared cars don't get used. So you look at taxi ranks from 9:30 onwards, they're roughly sitting around all day until we get about 3:30, and that's when they get busy again. So these cars, being electric, can be recharged during that time. So you won't, if you're going to be using electric cars, then you won't need petrol stations as much. So you won't need petrol. You won't also need a lot of the servicing that goes with cars, all the car mechanics. You won't need as many of those. If everyone who has two cars now has one car and an autonomous car, then you're going to really cut back on the number of service stations needed and mechanics. So this is going to be a major change. Major change. We all expect to own a car, and we have been used to that for over 100 years now. Also repairs, you won't have to take to get it serviced. Electric cars, for instance, have a lot less servicing requirements, because you've only got an electric motor and a battery. You don't need to change oil, you don't need to do a lot of things in the car that you do with a normal car. The autonomous cars can be smaller, because they're probably going to be catering for basically 1 or 2 people rather than 3 to 4, so they're going to have less space. That means you don't need as many, for every kilometre of highway, you can actually pack more cars in. So where you see down in Sydney, where they used to, every 10 years they have to go from a 2-lane highway to a 3-lane highway, because it's just got so much congestion on it, they won't need to expand the highway system as much. So it has impacts on the road congestion as well as the need for more highways. So there's huge amounts of impact. So they're saying that by 2030, 10 to 25% of cars could be autonomous. And I think the 2 areas it's going to be is in the second, for the people who want second cars, and the second one is for taxis, or the Uber system. So what I think will happen is Uber will start to buy the autonomous cars. In fact, there was an article today that Volvo is now going to produce an autonomous car for Uber. And they then won't need the drivers. So you've got another cost reduction. You don't need people sitting around for half the day, because you've got no labour element in there. There's no driver. So that would then drop the cost of taxis, because effectively the taxis that we know now wouldn't be there. We just have cars roaming around, and you go on your mobile, hit the app, it comes to your door, it's roaming around your suburb, it's roaming around the city, and so you'll get a very quick service, because they can keep these things just roaming for 3 to 5 hours a day. They just recharge, but they're effectively going to have this system of roaming cars giving services to people. The other big issue is that about 1/3 of our urban land is car spaces. Think of every street. You've got 2 lots of car spaces on both sides. You've got garages, you've got car parks. Huge amounts of area being used just to park cars. And if you don't need that, well, they get released now. You obviously wouldn't release the car park spaces on the street, but there's a lot of land on your own home that could be released for other things. And so that might mean that you won't need your garage for a start, so there's another room for your house. if you're going to build a house, you won't. If you don't need a garage, you won't build a garage. So therefore, you can either have a smaller block, or you can just have more features in your house. You might make that into a film room or a rumpus room, whatever. But it's just releasing capital out of the whole system, releasing assets that you can use somewhere else. So basically, we're saying you got the option of having people go to work now. The kids go to work in the autonomous cars, maybe. They don't need a driver, so there releases the wife from dropping kids off at school. She then could go to work straight away. Wives or husband, whichever takes the car and the kids to school. So that makes your economy more productive, because you've got people at work where they used to be sitting in cars. That's a huge benefit for the whole economy. It means that the wealth of the economy goes up because more people can be more productive. And they potentially have less accidents because autonomous cars have got a lot more features in them to protect you from hitting things. And I think there was that's right. Well, 1.5 million people a year die in cars. So potentially, if you didn't have less accidents, you're going to have less deaths. You're going to have less injuries. It's a huge effect of not plugging up the hospitals or car accidents. And the other thing, as I said, that if you're not going to be using taxis in a way, Uber can then use these ride-sharing cars to provide a lot more services because they're going to be cheaper. So if a taxi service is cheaper, you'll use more of it. Instead of thinking, oh, I'll go down to the shops, it's going to be potentially cheaper to use these sort of services. And of course, accidents do happen because people get fatigued, have too much to drink, micro sleeps, and lack of concentration. People have accidents all the time because of this. So the problem is that people have got to get used to the fact that you're relying on someone else to drive the car. But when you think about a lot of urban areas where these will be used, well, your maximum speed limit is 100 k's. But for most of the time in urban areas, they're actually going only 60 k's because they're going from one traffic light to another. So a lot of high density areas, you're not really going that fast, even if there is an accident. So I think that the point is that for a lot of people who travel 1 to 2 hours a day in a car, if you can do something else with your time, you're going to be much better off. And I think this is where the outer areas of Sydney and Melbourne, any of the big cities, people who commute more than 1 to 2 hours a day will pick this up as the way to go to work. Because a lot of these parts of Sydney and Melbourne don't get serviced very well with public transport. Therefore they say, oh, well, I can't get to where I want to go because the train or the bus doesn't go to where I want to go, so they have to then drive their car to a destination that's out of the normal public service routes. But if you've got autonomous cars that can take you directly there and you don't have to drive it there, there's going to be a big incentive, plus the cost factor of being able to get these cars to do it cheaper, a lot cheaper than the current system. So the only thing is, there's a few issues there. You won't have road rage because you can't blame anyone else but yourself, and you can't get lost, so that's a pretty good thing. So anyway, the big concern, of course, is the technology. People have to get in a car, there's no steering wheel, there's no brakes, there's nothing. They've got to believe it's going to take them there. So people are going to have to get over that resistance of having that technology work. Apparently in America they had a car, did 1 million kilometres, I think, around American roads. They had another car following it, but they had all the radar and all sorts of things on it to drive itself. And they had 2 accidents where people ran into them. They didn't have any accidents where they made a mistake with their sensors and not working. It was other people's mistakes were causing the accidents. So that's interesting. So it's getting obviously getting pretty well developed. It's obviously the next step. It's getting acceptance by people to take them up. The biggest issue I see is that people will want, if they're going to do commuting in cities, there's going to be high peak demand between the 7:30 to 9:30 and 3:30 to 5:30 time. So maybe you might not have enough vehicles for that. But probably what will happen is that people who do the commute every day will buy their own autonomous car. And then they won't have to rely on something else. But where people in the congested part of the cities, like Sydney and Melbourne, where they don't have a car already, they'll be able to use these services much more regularly because they'll just get to work or wherever they want to go because these cars will be just roaming around. The only thing is some people love driving cars. I think that's probably more of a overstated for short trips. You know, you might like to do short trips, but for people in Sydney and Melbourne who do 2 or 3 hours a day, I don't think they really want to sit there driving every day. They'd rather give it to someone else if they could. And you might not have an autonomous car that's big enough to carry groceries and, you know, if you're going to move furniture or something. But, you know, that's pretty limited. I don't think there's a lot of people who, you know, need a big car for everything. And, of course, there's always things like Woolworths do deliveries or Coles do deliveries, so you can still go and shop in your autonomous car and get deliveries done by another service. So as I said, I think that they're going to be used in the high density cities like London, New York, Paris, those sort of where people don't have a car for a start, they're relying on taxis and public transport. I think they'll pick that sort of service up first. And the other one will be where you've got people in the outer areas of Sydney and Melbourne and big cities who do a commute every day, 2 or 3 hours, just long, boring days of sitting in cars and traffic jams. I think they'll be attracted to it because it'll be so much cheaper and easier for them. And they won't even have to pay for parking when they get there. That's a big thing. I know in Sydney, you go to Sydney, you might get there and then you find where do we park? And then when you come out, it's $50 parking fee. So Sydney's probably one of the first to do that. But potentially people can watch movies, do their homework, do work at work. There's a lot of wasted time for people in the big cities who are not very productive. So your productivity will be better because you might go back to work more relaxed because you're not sitting in traffic jam for 2 hours to get there and 2 hours to get home. You can talk to your friends on the mobile, you can do all sorts of things instead of driving a car. So it's going to be interesting to see how it all evolves, but that's why I see it evolving. So here's a bit of a thumbnail sketch of what will happen over time, but there's some cars coming out already which are automated, but they haven't really got to the roads yet because the government's got to approve them. Then potentially you still have a steering wheel and a brake and so forth, but you can just set the car on automatic so that you still feel that you can take over if you want to. And then effectively you get rid of the steering wheel and the brakes and so forth, and then potentially over time a lot more people will just pick it up because effectively it gets accepted that you can use these things safely. As I said, they're being sort of used already or tested already. So an example in Germany was where potentially the bus was fine, the automated bus was fine, but then someone backed into it when it was doing its delivery. So as I said, they're finding that the actual accidents are not happening from the vehicle failing, it's from other people's failures. This one's Chrysler Pacifica. It's being tested on public roads already, and looks a little bit ugly there, but obviously they've got to have a lot more sensors up here, basically radar type things, to sense what's around it and to interpret that. Autonomous car parks, which will potentially go hand in hand with this, because if it goes electric, then you'll need to recharge them every 3 to 5 hours. But then again, for most cars, they're not being used after 6 or 7 o'clock at night and only get used again from around 6 o'clock in the morning. So there's a lot of period of time where you can recharge electric cars, and potentially what the advantage of these autonomous car parking is that they can pack a lot more into a very limited space. So that's an example of good car parks. So all we're saying is that if you can get an economy to work more efficiently, you're going to be more wealthy. And this is what potentially is the big bonus for our economies, is that we've got the technology revolution with internet, mobile phones, but this is another jump in technology where we can more efficiently get people around, cheaper and easier. And that's where you can then potentially have people are arriving more refreshed at work. They're not as tired. They can be more efficient at work, and they can also do work as to and from if they want to. And you're going to get a lower cost of transport because you're sharing that resource with more people. If you share it with 2 people, the cost of that investment is shared by 2 people. If you have 3 people, you're going to share it with 3 people. And therefore, you can divide out the cost of that car between many people. And that's just going to drive the price down. Potentially, there's going to be losses of jobs because potentially, you won't need taxi drivers. They sit around for half the day doing nothing. Not a very productive way of earning a living. So therefore, if they went and did something else with their time, they could find a job where they're going to get better paid anyway. So it doesn't mean that you lose those people who instantly become employed and never get a job again. They'll find other jobs. Car mechanics potentially won't be as much demand because, as I said, electric cars generally don't need as much servicing. You won't need to buy a car, so you won't need to as many people in the sales area. But there's a release of money. Because you're not spending it on cars, you can do something else with it. You might want to travel, you might want to spend more in your in your house. You can spend more on electronic goods. That releases money to be spent in other areas where you want to spend it. Because effectively a car is being locked up, that money being locked up in a car, you have no discretion on it. You either have a car or you don't have a car. Once you spend your money, you're going to be spending, say, $7,000 to $15,000 a year, making that car a cost structure in your business or in your personal life. If you don't have to spend that money, you'd spend it on something else. And that then employs the people who lose their jobs. So if the taxi driver loses their jobs and people spend more money on going to restaurants or theatres and movies, that's where they get employed. So this is not a bad thing, it's a good thing because the taxi driver gets a better job. You can spend more money on entertainment or whatever you want to do, and the whole economy is better off. So it has big implications on making us wealthier. So what we're saying is the next time you're sitting in a traffic jam, you're thinking, well, there's got to be a better way. And potentially that's going to happen. It's just a matter of how quickly it gets adopted and where it gets adopted. I think it's not I think it's just going to happen. And we know that the big cities around the world are already just facing this huge problem of congestion. It doesn't get any better. It gets worse every year. They keep building more roads, but they just can't keep up the road building to the number of cars being put on the road. So you can see here, if you had smaller cars, you'd have more cars in that space, but potentially you'd have a much quicker flow of traffic because I think the traffic flows would be better as well. But anyway, that's just something for you to think about for over Christmas time. Buy a new autonomous car.